Hello, I'm your host, Efi Pylarinou, and today I'm in a delightful position for two reasons. One, I am in Montreal, Canada, which is a dear place for me. I started my digital endeavors here, and I will explain later. And second is my guest today is David Gyori, who we recently met in person at the Cyprus Fintech Summit, and we had a blast in terms of the content that we shared. David is an amazing, I would say, fintech performer. I have to confess that at some point I was a bit jealous because all my life I've wanted to be a fintech stand-up comedian, which goes a bit beyond, saying jokes. And I must say that the panel, David, that you were on at the summit, you had really an amazing stand-up comedian type of performance. So let me, first of all, welcome you.
Thank you. It's great to be on Conversations and Insights. By the way, I like these conversations and insights. This is exactly what we need.
Yeah, and for our audience, I mean, David wears a lot of hats. We know each other from the early days of fintech when the series of crowdsourced fintech books was first launched. We both participated in the first fintech book by Wiley. And then we also participated in the wealth tech book. David has participated in many more, I think 5 total, right, David?
4 in this amazing crowdsourced series, and one more actually in cooperation with Patrick, your prior subject of interview in the series.
Yeah, yeah. So and what you have been doing and contributing in the fintech and financial services ecosystem is you have been training bankers. Now that is a mission. You have to be passionate to undertake that mission. It is not an easy one. It is, of course, it's got this duality of, okay, you need to keep up with all the fintech trends, but you also have to deal with all the business culture and the business as usual issues of incumbents that have to change, have to transform, have their own ways, their own resistances, and their buy-in has been notoriously slow and resisting. So I applaud you for that, and I'm sure we'll have the opportunity to talk about that, where you've worked. When I think of you, I think of David looking to the east. We are both basically in Europe, right? And you've been working, but you go far to the east. I know you're involved in different associations and initiatives from Seoul to Singapore and so on. So this is very exciting. And I will dive into one of the things that has impressed me and resonating is your way of thinking of fintech as a galaxy. And it's a wonderful visual, because in a galaxy there are all sorts of planets. There's lots of space, there's lots of stars, planets, movements, there's death and birth, there's explosions, and so on. And hopefully we will go on a space journey together today. So tell us first a bit about this galaxy vision and how many dimensions are you seeing in that?
Right. So thank you, Efi. and it's great to be on Conversations and Insights. I am excited talking to you anyway. I have listened to some of the prior conversations and the quality, the intellectual nature is very impressive. So it's a great honor to be here. In my galaxy of fintech, in my galaxy of financial technology, we have 7 solar systems. In each solar systems, we have planets. There is one star, and there are planets revolving around this star. In our galaxy of financial technology, currently we have 40 planets in 7 solar systems, and around each planet we have moons. These moons are the sub-areas of fintech. Now, listing 40 different, distinct, exciting, dynamic, exponential, emerging areas of financial technology currently going on, currently unfolding, currently manifesting around us is very easy. And when I look at my list of 40 areas of financial technology, in each of these areas, I see 10, 20 sub areas. Now, when you start to multiply that, that is like 800 or 1,000 emerging developments, emerging technologies, emerging business models, emerging risk-reward distributions going on currently globally around us. This is why this is a beautiful yet challenging time to manage a bank, to manage a challenger bank, to manage a neobank nowadays anywhere around the world. So this galaxy of fintech, the number one thing to spot is that it's highly complex. There are many, many, many areas emerging at the same time. This is why sometimes we talk about the fintech revolution, because this is a very dynamic, often exponential process, hard to intellectually capture and extremely hard to strategize and to tactically and operatively implement, deliver in a highly compliant, complex environment such as banking. So we have a tension, a difficulty here. How do you keep your hands on this very complex, very dynamic universe, this very complex, very colorful, very dynamic galaxy, while you are managing a slow moving, highly compliant, risk-averse by nature, leveraged, responsible retail bank?
And the interconnectivity between all these solar systems and planets and so on is changing continuously, because it is dynamic, and it's extremely difficult to sort of keep up with all this and follow and adjust your path as to what needs to be done. So, I mean, we could spend 7 episodes, one on each dimension, right? And one on each solar system. What I would invite you today is let's pick one of those dimensions. And I'd love to zoom into mobile wallets. And you know, depending on who I'm talking to, I say there's, the mobile wallets of Web 2, the Apple wallets, the Google wallets, and so on. And then there's the Web 3 wallets that really are very different. And I'm not sure that a lot of people understand the difference. And as I like to say, I don't think that we've really seen smart wallets in the true sense of really data flow that is frictionless between parties involved, whether it's the merchants, the customers, or whatever intermediaries and so on. So we're on a journey that is touching many, many points. And I'd like to invite you to tell us, are mobile wallets one of the dimensions? Is it a solar system for you? Is it a planet? How do you think of it? And just share your thoughts.
Okay, so in the galaxy of financial technology, we have 7 solar systems. Number 1 is Paytech. This is where mobile wallets belong in my classification. And by the way, your recent prior conversation with Patrick about CBDCs, even CBDCs, central bank digital currencies, belong to the wider Paytech solar system. The second solar system is channel tech, voice banking, augmented reality, virtual reality belong here. The third one is data tech, big data, blockchain, artificial intelligence. All belong here. Why? Because the input resource of artificial intelligence is not oil or gas. The input resource of artificial intelligence is data. The fourth solar system within the galaxy of financial technology is land tech, credit tech, from BNPL to peer-to-peer lending, from crowdfunding to nano-finance. Many, many emerging areas belong here. The fifth solar system within the galaxy of fintech is wealth tech, from robo-advisors to copy trading such as eToro, from personal finance dashboards to the entire concept, ethos, and universe of API banking, application programming interfaces, from asset tokenization to digital currencies and so on. The sixth solar system in the galaxy of fintech is RegTech, from cybersecurity to risk tech, from biometrics to digital identity, from supervisory technology to compliance technology, from many, many other areas. And number 7, the 7th solar system in the galaxy of fintech is all other areas. For example, the entire area of insurtech, with thousands of startups globally, environmental, social, and governance tech, quantum finance emerging in front of our eyes, core banking tech, neobanks, challenger banks, and so on. Now, these 7 solar systems are interconnected in a premeditated and conscious and organized way. Let me tell you this way, and then I will move to mobile wallets specifically. So, Paytech, channel tech, data tech, land tech, credit tech, wealth tech, reg tech, and others. Let's look at it in an interconnected way. Payments, modern payments, digital-only payments will be the basis of the new value creation of credit institutions, licensed banks. These payments will go through new channels. The current incumbent number 1 channel in banking globally is the good old smartphone. iPhone 1, the first iPhone, has been introduced by Steve Jobs on the 27th of June 2007. So now it's a 16 years old device, and iPhone 15 is just coming out. Now, after this 15-year cycle will come augmented reality and virtual reality. Recently, at a large conference in Egypt, where I was a keynote speaker, I had the chance to test MasterCard virtual reality payments. And I went to a three-dimensional VR store, and I initiated and completed successfully a payment with MasterCard. Well, there was no physical card involved, obviously, but these things are coming to us. These payments will produce rich data. Can you remember? Data tech is the third solar system. This rich data will be the #1 value driver in modern days upcoming banking paradigm. Why? Because based on this rich data, ISO 20022 and beyond, banks will be able to build in an individualized way assets and liabilities. What are assets on the balance sheet of traditional banks? Lending, active products. That's why the fourth solar system is land tech, credit tech. Use the big data, use the smart data, use AI, and build a very good asset side of your balance sheet. But we know from recent international developments that the liability side of your balance sheet matters equally. That's why the fifth solar system in the galaxy of fintech is wealth tech. Build passive products, savings, liquidity, asset management, wealth management. And all of this, all five, must happen in a regulated, fully compliant way. That's why the sixth solar system is RegTech. And then the seventh is the other areas. So this is the logic of interconnectedness in the modern days banking. I also like to call it banking 2050. By 2050, actually, this fundamental model will dominate the value creation of banking. Where is the value creation here? The good old net interest margin. The net interest margin between the asset side and the liability side of your balance sheet. That has been the primary name of the game in the past 5,000 years, and it will remain to be the primary profit driver in banking, however reimagined in the galaxy of fintech. Now, let's go back to Paytech, the first solar system, and within Paytech, the area you have picked, mobile wallets. So, shall I go ahead and share with
I will
you?
interrupt you, David, here, because as I'm listening to you, I'm fascinated about these dimensions. I must say that the number 7 of the solar systems doesn't seem to me coincidental. It absolutely brought to my mind the 7 chakras that are interconnected, and the 7th one being the highest one, which has all these advanced, quantum computing and everything has to become in alignment, to come in alignment to create something valuable. Otherwise, it is not possible to do this. So it's an analogy that came to my mind, and I invite us all, you, me, and our listeners, to sort of carry that and sleep on that and see where it takes, because these analogies are the same. We are also in ourselves as individuals a solar system, right? I mean, and a very complex one too. Each cell in ourselves is like that. So in that sense, we have to see that. And for me, all this invites us to what I believe is driving everything, which is openness. Openness will allow us to create the right interconnectedness for each of these new business models, each of these values to appear. So that's what I wanted to share with you, and let you take a deep dive into the mobile wallets.
Right. I totally agree with you. For example, in this area number 7, others are digital-only banks, which is a very important reimagination and synthesis and licensed, risk-managed reincarnation of bricks and mortar incumbent traditional banks. By the way, I want to advise a bank from anywhere around the world, which bank volunteers to become the #1 bank, the best bank globally in augmented reality and virtual reality, the #1 channel of the longer term future. So I am here, I am ready, and this is a beautiful potential journey across the galaxy of fintech. Going back to mobile wallets, so this is a beautiful area. Currently, almost 70% of adults globally, almost 70% of the people currently living on Earth over the age of 18 use one or more mobile wallets. This is very, very important. However, regulatorily, the European Union happens to be a leader. EU regulations on different new categories of potential financial services providers are actually very exciting, and you know very well that many other jurisdictions are following EU regulatory developments, and they are trying to learn from EU regulations and make them even better and reimagine them. Now, on the 28th of June this year, the European Commission put forward the first draft version of PSD3, which is also called PSR1, Payment Services Regulation 1. But let's just call it PSD3. And actually, this PSD3 proposal is relatively significantly re-regulates the status of mobile wallets, usually currently licensed as EMIs, e-money institutions. So, results reached by mobile wallets so far, for example, never before seen level of quality, reliable financial inclusion globally. This is a huge achievement, and mobile wallets have contributed to this immensely. The global success of QR code-based payments, the global success of moving from cash-based societies towards less cash and more often towards de facto cashless societies is also one of the achievements of mobile wallets, besides more traditional tools of payments such as tap and pay, PayPass, PayWave, NFC, RFID. I am trying to use the different terminologies. Basically contactless payments conducted with plastic cards as well as with mobile wallets have contributed very significantly to cashless societies. However, driven by the logic of PSD3 and driven by the deeper logic of disruption, as per described by Clayton Christensen, the ex-legendary professor of Harvard Business School. So both by business logic and by regulatory background, the next chapter will be mobile wallets becoming licensed credit institutions, digital-only banks. And this is a very serious and hard step to take, serious investment. And actually, some mobile wallets will be able to take this step successfully. Some e-money institutions will be able to take this step upwards successfully. Some will not be able to take this, and slowly they will become less relevant. By the way, this step is controversial, but it is slowly, I am talking about a 10-20-year time horizon, it will become a must. Now, meanwhile, there will be something very beautiful, something historically relevant happening to mobile wallets. A new class, a new type of mobile wallets will slowly emerge, and that is the category of CBDC wallets, central bank digital currency wallets. Retail central bank digital currencies are most likely to materialize in dedicated CBDC wallets developed and run by retail banks or developed and run by central banks. Yep. And actually, citizens, entities will be able to store local currency liquidity in these CBDC wallets. Digital money stored in these CBDC wallets will be direct liability of central bank. Yeah. There will be no intermediated risk between the user and the central bank, i.e., there will not be a deposit insured but still somewhat risky intermediary of retail banks between the users and the central banks. And this will therefore be a new, historically new class of assets, a direct liability of central banks in digital format. currently, globally, we only have direct liabilities of central banks available to the general public in physical format. Coins and paper money, good old paper money, first regularly printed by the Tang dynasty in China in 745. Good old coins, first regularly consciously minted in Lydia, in Western Anatolia, nowadays Turkey, about 5,000 years ago. Well, I have news. These 5,000 years, 1,300 years old solutions are outdated, not conceptually.
Bearer instruments, bearer instruments.
Technologically, they are outdated. Now, here comes something very important. When we think about cashless societies, cash de facto going out of circulation, but central banks keeping the privilege and the tool of monetary transmission of having an impact, decisive impact on narrow money, i.e. direct liability of central banks circulating in the economy, when these two things mutually happen, a new era of economics, a new era of monetary policy, a new era of central banking will come to us. Honestly, it will be like, in terms of monetary policy, it will be like the discovery of antibiotics was in terms of medical science. Why? Because when we imagine a purely cashless society with central bank digital currency up to a limited balance stored in the dedicated CBDC wallets of citizens. So when we imagine this situation, actually the long-awaited, historically awaited, and historically missed symmetry of monetary policy, symmetry of interest rate policy will open up. Central banks in the past 200 years have had the monetary tool to raise interest rates. No, nominal. I'm talking about nominal interest rates. Every time I will say interest rates in this context, think about nominal interest rates as high as they want. However, negative interest rates couldn't be used as a monetary tool. Why? Because when the nominal interest rate level becomes too much negative, actors in the economy start to withdraw their money from the financial intermediary system and keep it in cash. You have to calculate the cost of cash logistics, the cost of keeping cash. I am not talking about $10,000 or $100,000. I am talking about the costs of keeping hundreds of millions of dollars in cash. And actually, globally, internationally, we can calculate those costs pretty well. And the cost level happens to be around 80 basis points per year. This is why the negative lower barrier of nominal interest rates has been 0.75% approximately. You are currently living in Switzerland. Ask the Swiss National Bank how many times they tried to calculate how much negative you can go. However, when we have a truly cashless society, then negative interest rates as a viable monetary tool symmetrically to positive interest rates open up. And that will bring a truly new era of economic, macroeconomic stability, a truly new era of counter-cyclical monetary policy, because we will be able to stimulate through the nominal interest rate channel as a monetary tool equally as to restrict. And that is very, very interesting. How will markets react? How will central bankers learn and practice this new channel? How fiscal policy will go along? So this is a very, very beautiful. And by the way, this negative interest rate channel opening up in a purely cashless society is the name of the game. This is why purely cashless societies will happen with the assistance of central banks, and central banks actually will use this tool. It will be nothing less than antibiotics in the history of humanity.
David, this is very insightful and forward-looking. Obviously, this is not going to happen overnight. It will take time, whether it's 1 decade or 2 decades, 2050, and so on. On the journey towards that direction, and obviously each economy will be in a different trajectory. Do you see the cap in terms of the amount of money we can hold in our wallet directly with the central bank as continuously rising? And is that part, do you think of it as part of the monetary policy of the central bank?
It's a very, very interesting question. How the arbitrage between CBDC liquidity versus retail bank current account, savings account, deposit liquidity will be managed,
Right.
because there is a risk arbitrage. Simplifying it very much, holding CBDCs by definition will have less risk than holding retail bank liquidity. However, first of all, deposit insurance and CBDC liquidity will have to be coordinated. Second of all, CBDC liquidity will have to be limited, just like the amount of cash, physical cash in an economy is limited. And sometimes merchants in real life turn to you and they say, well, now I don't have enough cash in my cash registry machine, or I don't have enough coins, or I cannot give you back the change if you use the highest denomination paper money, and so on. Anyway, CBDC liquidity will probably be limited per user, and also CBDC foreign exchange transactions will be a very, very delicate, the convertibility, so to speak, of retail CBDC will be a very delicate topic. By the way, the PBOC, the People's Bank of China, in the past 10 years has done very, 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 very high quality research and piloting, or even more than piloting occasionally, of retail CBDCs. However, there was one caveat, in my humble opinion, in the way the People's Bank of China has been looking at CBDC. By the way, what triggered this high level of professional enthusiasm of the PBOC? Well, WeChat Pay, Alipay, the mobile wallets driving Chinese society from a cash-based society, first paper money, Tang Dynasty, 745, Marco Polo going back to European 1295 from China, showing the paper money and trying to convince late 13th century European leaders to adopt the paper money, which had been used in China for over 550 years at that point. Anyway, so the prospect of truly cashless society triggered the People's Bank of China to go deep in in this topic. However, the PBOC tried to create a dual circulation CBDC, local circulation, and at the same time international circulation. And that is a very, very complex task. Local circulation CBDC, but if it's only local circulation, then there is no de facto convertibility, keep it in mind. So you lose the potential current level of convertibility of the direct liabilities of the central bank in your local currency denomination. It's not necessarily the greatest loss, because you can still convert bank account money. However, it is a certain level of loss, and creating cross-border international circulation CBDCs, that's the trillion-dollar question. However, that's a global political question, because that touches the current global macroeconomic, monetary, financial status quo as it is. So international circulation CBDC is a very, 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 very serious question, and a very, very, very sensitive question. Local circulation CBDCs will have limits in terms of maximum liquidity per wallet, but these limits will have to be carefully coordinated with other metrics in the economy. And by the way, one of the tools of controlling narrow money from a central bank perspective will be about moving these limits. By the way, in the recent episode with Patrick, you have also touched the privacy aspect, or let's be more honest, the lack of privacy by design aspect of CBDCs. Obviously, one of the advantages from a citizen's point of view in terms of cash is the high level of potential privacy. And this is de facto lost through central bank digital currencies. However, central banks, governments, sovereigns, states can practice a certain level of constitutional self-restriction in terms of looking at exact transactions. For example, they can say that these transactions are not visible to the state unless there is an ongoing valid criminal investigation where an independent judge or a panel of independent judges proclaims that knowing these transactions is an important aspect to the case. So there can be several levels of self-restriction, and these different limits of liquidity in a CBDC wallet can also have different levels of privacy attached.
Yes.
So you can have like I'm making
a tiered system. Yeah.
Exactly. So you can have like 100 euros per month or 500 euros of total maximum balance of full privacy. It can even be excluded from criminal cases. Then another 5,000 euro of privacy, but it can be opened up towards criminal cases. And then another 20,000 euro, which is always visible to the state. Anyway, it's a very, very long story. And actually, we central bankers, advisors, thinkers, opinion leaders, retail bankers, investment bankers, legislators, politicians, decision makers, we are writing this history right now.
Yes, yes. David, this is actually fascinating. And I always like to say, don't think that we can do nothing. We can, with our voices, each of us, participate in all this by thinking, by discussing each on our own way, because it is being shaped up as we speak, and it will take a long time. I want to thank you. This was a very fascinating discussion. I look forward to more. And obviously, I will publish with for our audience where they can find you on LinkedIn and follow your work. Thank you so much.
Yes, thank you very much. It's a great honor to be on Conversations and Insights. And I am very thankful to the viewers, listeners. And please ask questions. Please write your comments, because I will do my best to react to this. I will do my best to start an interactive back and forth of communications below this video in YouTube. And I think through this conversation, we can create additional value, and also we can create topics for future upcoming episodes. So dear listeners, dear viewers, please ask the tough questions. Please criticize my thoughts, because I am here to interact with you.
Yes, and we are not here to be right and show off. We are here really to have this conversation, to share insights, and our understandings, and just bring diversity to this discussion. Thank you, David, again.